Hey Anton, how are you? I'm very well. Can you hear me clearly? Fantastic. Yeah, I can hear you. Everything's working very well over here.
Yes, I can hear you okay. Just checking my.
Okay. Oh, sorry. Okay, fine. Fine.
In one day.
Thank you. Hi, I'm Harriet Formby. I am the founder of Below the Line Finance. So I'm a fractional CFO and chartered accountant. I typically work with startups, SMEs, scale-ups, and other kind of growth-focused organizations in the kind of tech creative space, usually with a sort of sustainability focus. And it's very much about, moving from really good financial foundations to strategic commercial decision making and ensuring that the finances support their growth ambitions in a scalable way that aligns with the founder mindset. So I do lots of work around how it actually feels to manage money and finances when you are probably not a finance person yourself in business and you're maybe having to deal with it for the first time.
It's a nightmare. Sam.
Excellent. My name is Samuel Ajala. I'm a fractional CFO. I help founders turn chaos into clarity as they scale their business. I'm the founder of StartUp CFO and also a partner in Arthur Hamilton Accountancy. I have a background in finance leadership and track records supporting over 500 startups, usually within SaaS-based or high-growth companies. And I work closely with their founders to extend runway and optimize cash flow, build investor-ready financial systems, align financial strategies with aligning plans, and support boards, fundraising, and M&A readiness. And that's me in a nutshell.
Thank you, Sam. Last but not least, money. You need to unmute, money.
Apologies. Good day, everybody. My name is Mani Kanabe. I'm a partner at Right CFO. We are a fractional CFO firm. We support early stage businesses from startups, scale-ups, and SMEs as well. We're a firm of 6 fractional CFOs. In terms of my own expertise, I'm focused on the creative sector and the tech sector. So I help a lot of creative businesses in growing and scaling their businesses and let them focus on the creative aspects of their businesses. This might include, obviously, understanding their cash flow, making sure that that creativity is turning into profitability, and then fundraising and expanding their businesses. And, we've been doing it for quite some time. We're very passionate about what we do. And we love working with startups and scaling businesses and SMEs. That's me in a nutshell.
That is an absolute stellar panel, and I really appreciate all 3 of you for joining us. I guess a quick reminder to the people in the audience, especially those that are on the live streams. This is Startup Finances Q&A. We do this every 3rd Friday of the month, normally, where we seek to help startups like yourselves with whatever questions you may have in terms of your business finances. The idea is quite simple. If you're tuning in via the live streams, please remember that unfortunately we are unable to monitor your questions there. But if you do want to ask our panel, you'd need to join us here on Microsoft Teams. Either click on the links on those live streams or simply go to our website, startuptoscaleup.club, look for Startup Finances Q&A 04, click join, quick registration, gets you a link to your email, and through that link you can join us. When you're here, just drop your question in the chat and then we'll give you the mic. By the way, it's audio only, so if you're like me, you won't need to spend hours in front of the mirror to get ready. You can join us from anywhere you are via any platform or device. And your questions today can be on anything to do with finances, whether it's cash flow, budgeting, profits and loss, payroll, employee benefits, taxation, bookkeeping, VAT, auditing, loans, banking, frauds, projections, forecasting, templates, and all that jazz. There literally are no wrong questions, and there's no need to be shy or, well, it's a learning curve for us all. Now, if your questions, however, are not on finances today, please save them for the other conversations we host. On Mondays, it's talent. On Tuesdays, it's product and tech. On Wednesdays, it's growth. On Thursdays, it's fundraising. And on the second Friday of each month, it's UK Startup Law. And as you can see today, on the third Friday of each month, it's UK Startup Finances normally. And you can RSVP to any of those via our site, startuptoscaleup.club. Maybe we can start with Sam on this, and then Harriet, and then Manny. What are your do's and don'ts when it comes to early stage finances? Maybe we can start with one each, so one do and one don't. And if we can, maybe not use the same for both do and don'ts. So take it away, Manny. Then Harriet, sorry, not Manny, my bad. Samuel, Harriet, and then Manny. You would need to unmute, Samuel.
Sorry, guys. I was actually talking away there.
That's okay.
One of the things I would
go on.
suggest, one of the things I would suggest for startups and early stage businesses is validate your financial models early. Right? I think that this is extremely important, especially if you're going for funding. What usually I find with a lot of startups is just the visibility of their business. What is their cash position in 1 month, 2 months, and 3 months' time? Are you looking to hire somebody? But do you have the liquidity within the business to ensure you can support that? And so I think getting that early, I think what I find with a lot of startups is they tend to do it when things get a bit serious from their perspective. But the reality is that this is something you should try to do quite early on, right? And what I would suggest that you don't, I find this very common, and I would certainly advise against it. Don't raise without knowing your burn and your runway. A lot of startups we've worked with, especially when they're pitching their ideas to potential investors, this is a common question that comes up. And you can almost imagine the reaction of the investor asking this question and they're not able to give a very clear enough answer. You're asking an individual to invest all this money, and yet you're not able to tell him how long or how much cash you have in a business that can survive for within your organization. It can be quite telling, and it's something that I would advise startups don't do, and ensure that they are on top of their burn rate and runway as well.
Very good point. Harriet, it's your turn. And then Manu, please.
Thank you. So I would say one thing to do is, well, there's kind of two sides to it, I suppose. I'll start with don't actually. Sometimes I see people go, well, I created the cash flow, I've created the model, tick, done, let's go on to something else. And I know it's tempting to do that because you've got lots of hats you're wearing and you're doing lots of different things. But I would really, really say keep these financial documents and plans and forecasts as live documents and keep revisiting them, because you need to keep updating, your assumptions, your models, as the ideas and the plans shift and evolve as well. So I'd say make sure you are treating your financial documents as kind of like a living, breathing thing rather than just a tick list thing to do, because otherwise they get outdated very quickly and then they are not particularly helpful. So I think I've merged do and a date together then, so hopefully that's all right.
All right. Can I go ahead? Hello? Can you hear me?
Yes, please, yes, please, Manny. It's your
Okay,
turn.
great. Oh, great. So thanks for that, guys. I mean, I don't want to sound like a broken record, right? One of my key do's for any startup is to have a clear and comprehensive business plan, which, should give you a clear 12 months budget as well. Ideally, I would suggest a 3-year business plan, but a more detailed 12 months budget. This gives you a lot of clarity. This allows you to be able to extrapolate what your weekly or monthly goals should be. This allows you to be able to have regular business reviews, maybe monthly, against what your budget is or your business plan is. This allows you to make sure you're tracking progress, because at this early stage, you need to make sure you are accountable to what you set your mind to achieve. I think this is very, very important. A clear business plan with a detailed 12 months budget for you to make sure you're tracking the number of customers you want to acquire and your run rate in terms of expenses, is in line with your expectations. I think that is one of my first do's. Um, I think the other panelists have mentioned this as well. My key don't is don't ignore your cash flow. Cash is king, right? So you can't in any way or form ignore your cash burn. You need to know what balance you have in your bank account. You need to try and make sure that you know how much money is coming in, and if you have enough money to leave the light on. Those are two critical do's and don'ts, I think, any startup should bear in mind. I think they're just the baseline things. And I always make sure that the startups we work with have all of this together, because it sets a good foundation for them to then go on to grow the business and scale the business and achieve their full potential. Thank you.
Here. Well, thank you very much to all three of you. We'll now go on to some questions. If the others want to drop in questions too, please feel free to do that. I have dropped the question in the chat, but I'll read it out loud for those following via the live streams. By the way, if you're on the live streams, we can't monitor your questions there, so there's no point in trying to message me or comment because I can see my other phone flashing. So I've tried to format these in a nice way, these questions that came in, so hopefully I've done them justice. But so the first one is about managing burn rates during delayed funding rounds, and actually I've seen this happen all the time. The startup, they're a media tech startup providing AR content for immersive museum experiences. They're based in Gloucester, but they're actually planning to move to London. So she says the challenge we have is that a planned funding round has been delayed, forcing us to reduce cash burn without halting critical content production. Sorry, I forgot this. And it's also stopped us from moving to London now. The situation we have is that revenue generated seed funded with long-term partnerships in some cultural sectors. So the question is simple. Well, I don't know if it's simple, but that's what she says. As a media tech startup facing delays in securing funding, how can we reduce our cash burn rate without compromising key content production? Are there any UK specific options such as short-term financing, or she's talking about fundraising here? We can't really help with that here. Should have joined us yesterday. Through a British Business Bank programs or cost deferrals with suppliers or renegotiation of client payment terms. Should we explore to maintain operational momentum whilst navigating funding uncertainties? So aside from the fundraising part, and again, it would have been nicer if they were here for us to go through some questions. But aside from that, what would you do in this situation? Some of the things that you would advise for them to actually save some money and keep the lights on until they manage to either make some money or get some funding. Who we got? Let's start with Samuel again, because I think you're unmuted. So Samuel, then Manny, then Harriet, please.
Fantastic. This is a very, very good question. It does have a lot of technical errors that need to be addressed as it. Well, for me, the first thing is that they have to tactically reduce their burn rate without halting production. This is predominantly their core question here, right? And so since content creation is core, it's the core driver of their business, they wouldn't want to cut through it, they'd rather cut around it, right? So the things that come to mind is maybe prioritize high impact, high ROI content. So in other words, focus production on content tied to signed partnerships or even pilot agreements for quick wins. They can also defer non-critical hires or freelance support. So keep only essential creatives and technical staff. And I also say negotiate part-time or project-based contracts with contractors or agencies to match outgoings to active projects. Other areas, I think she kind of insinuated this, was negotiate any cash commitments, any contracts that she may have as well. I know that we're not necessarily addressing it now, but you know, in the UK, there's quite a number of alternatives. You've got the British Business Bank, startup loans, recovery loans, that's the BBB, RLS. So these are some of the options that she can go for, the individual option the question could go for. It just requires them to go and do some research, but she may actually get some support regarding this. Yeah, that's my thoughts.
Thanks. Yes, man. Manny, it's your turn.
Oh, Manny, oh, great. I mean, for me, you know, the critical thing here, because I've been involved in, you know, situations like this several times, is bootstrapping. You know, looking at every area of expense and to make sure we cut it down to the bare minimum while we you know, try and, you know, fundraise, and, you know, trying to explore, you know, how we can delay payment to, you know, to potential clients as well, and make them understand we're going through a fundraising process. As Dami already mentioned, we need to look at options for debt in terms of credit from banks and every other startup funding opportunity as well while we fundraise. But the key thing, end of the day, is to try and bootstrap and reduce the burn rate. You know, and look and say, look, we can't, there's certain things we can't do. You know, in some ugly situations which I've been involved in before, we've had to lay off people, we've had to reduce the hours they worked. But you need to really consider, you know, what the burn rate is, and understand that there's a wrong way to raising funds. It's not always as easy as a lot of entrepreneurs think it is. So you need to be able to bear that in mind, and we need to look at around all the costs. Which cost can we do without for now, and then till we fundraise, then and bootstrap, basically, the bare minimum to keep us going, and find some level of credit or debt from a bank or friends and family to help us stay, afloat, till we get the required funding to be able to inject cash into the business and grow the business. That would be my initial thoughts.
Thank you very much, Manny. Harriet, what would you do here? And also, is there any kind of rule of thumb that normally early stages should look out for in terms of cutting burn rates?
So so it's actually quite familiar to something that I've been involved in recently, and I don't know obviously the ins and outs of your situation and how you're structured, but they had quite a lot of freelancers, and that was the biggest chunk of cost, doing the content production and various elements of that process. And it was a case of going through, that was the biggest chunk of cost, of going through and working out what they could do in-house. And that was a bit, the founders were skilled. They just kind of specialized, outsource some of the specialist areas, but they were things they could do themselves. So it was a case for them of bringing some of that in-house for a period until they were able to, go back to the freelancers. And that's quite useful then, because if you've got freelancers that you can kind of turn on and turn off because that's your contract with them, that can be quite flexible then, rather than obviously relying on employees that you need to give fixed work to and always pay them. So that worked quite well. The other thing I would also just challenge on is, yes, there's some ways of looking at getting funds in, and I did think about maybe whether Creative UK would be relevant. Not sure what they've got specifically at the moment, but they might be, and potentially anything museum sector specific, any grant funding that might be related to that. But the other thing would be to push back and say, what can you do to generate some more revenue in terms of your offering? It might be an opportunity to say, well, let's review our offering, and is there anything that we can bring to market quickly that people are going to want and is going to be good for cash flow? So sometimes it's a case of how can we generate cash as well as reduce burn rate? What can we do differently to almost like self-generate the funds by it depends on, I don't know your specific offerings now, but is there anything you can do to influence that? That's what I'd sort of be looking at as well.
Thank you very much, Harriet. Okay, we'll now go on to our next question. I'll read it out loud for those on the live streams, and the panelists can read it in the chat. Again, today I've tried to format them in a way that I thought it was easier. Okay, so this is from an automating supplier payment process company. We're a SaaS startup offering project management tools for. Oh, sorry, my bad. Yeah. So the theme is automating supplier payment processes, and then he goes on to explain we're a SaaS startup offering project management tools for construction firms. We're based in Carlisle. The challenge we have is that our startup's manual payment processes seem to be a bit error prone and time consuming, leading to missed deadlines and strained supplier relationships. Basically, the situation is that revenue generating bootstrapped with an expanding customer base throughout the UK. So the question again is, as a SaaS startup reliant on multiple suppliers, how can we automate payment processes to reduce errors and improve efficiency whilst ensuring compliance with UK accounting standards? What specific UK focused systems such as integrated accounting and payment platforms or supplier onboarding tools with automated validation checks should we implement to maintain transparency and build stronger supplier relationships? Now, I think most of these popular systems would actually have this in place. But again, maybe we're trying to use free systems. Tell you what, let's start with Manny, then Harriet, And then Samuel, what would you do here?
I mean, first port of call is, I think, they probably need a fractional CFO to come in and try to understand the dynamics of the business. Because one thing I would try out, which, I get a general idea of the business, is to recommend systems where I don't fully understand the ins and outs of the business. But I think most of the systems, your Sage, and other accounting system out there at the moment are able to automate invoicing, but in a way that could, there's a lot of digital things being done now where your clients could actually be invoiced automatically, but it needs some input from your side in terms of processes as well. But I think there are loads of systems out there that can support. I think it's a good idea they're looking at putting a structure like this in place at this time of the business. I think it's really clever. But they should try and, what I would say is they should, when whatever system they decide to implement, there are a number of them available. Some of them are even subscription based, so you don't need to buy the software and implement. There's a lot of products out there at the moment, but they should make sure they can buy one that can scale as the business grows as well. That's what I would suggest. But there are lots of products out there, but they need like a fractional CFO to come and look at the dynamics of the business and give them maybe shortlist 3 systems. And based on their cash flow, decide if they should go for a subscription system or buying, a particular software, and how many users should that be. I think there's a lot of additional information that will be required to support a decision for them a buying decision in this situation. But I think there are loads of products out there. I think they're making the right decision now to be exploring what products they should actually implement. I think that's a good idea.
Very much, Harriet.
So I would suggest, and I agree, it's a lot of it's system based. So you can run some pretty big, complex functions, use it, and I'm not totally sure what size you are, but using something like Dext to pull in all of the invoice data, which is then coded with AI and parameters that you built into it, is really worth setting that up properly and making sure it really works, and everything can come into there, and then pushing that through to Xero. That'll create this is what you need to pay this week, etc. And you can then, you talked about efficiency, so you could then have that being approved and then pushed through to, I think it's Wise does it, where you can do a transfer, so you don't actually have to manually make the payments. It just kind of pulls through and integrates with your bank to do it. So that would be one way of looking at it. There are some specific software that help you with the approval process, so it kind of sticks in between that and actually helps with the who needs to approve it and the level of structure that's there. But a lot of it is actually having a process to say, right, we do, what is it? Is it a weekly payment run? Is it a monthly one? What are the steps that need to be in place to make that happen? And, doing something fairly simple, really, just to sort of structure it out and say, okay, this is what it's going to look like, and make sure that you have got people, whether it's outsourced bookkeeping and account support, or it's somebody's role within there, to look after it. And you can see some real differences just with these steps of suddenly, we're not missing payments for suppliers. It's smooth. We can manage our cash flow because we know what's coming up. And they are quite simple tools sometimes. Even when you're multi-millions, you can still be running off fairly simple steps.
Fantastic.
Just before you go, Samuel, and I don't know if the others might want to chime in as well after this, but I would think, especially for this kind of stuff, things like Sage and stuff, you can maybe speak to their support team and they might be able to show you once or twice, or maybe send you some videos. Does that happen?
Yeah,
now, I know you want obviously them to use a fractional CFO like yourselves, and I totally get that. But for things like this, certainly I think you can I don't know, get their support teams to send you a video or something, right?
I think you need to be very careful, because they're selling to you. You need someone that is more independent, that understands what you're trying to achieve. Yeah, they're selling to you so they can shortlist 2 or 3 systems and be able to guide you in terms of the pros and cons of each system. Then, so when you make a final decision, you know why you've made that decision. And the system that will be chosen as well, with the support of the fractional CFO, will integrate more to your type of business and the current systems you have. That expertise is not, I don't think most of those companies have in-house, or because they're trying to sell you their software. So you need someone that, so at the end of the day, having a fraction CFO to support you for a short period of time, project-based, will save you a lot of money in the end, because they will choose what is kind of, perfect for your type of business, help you negotiate the right price. Maybe you should go for a subscription-based, or you're buying the software in-house. And you can't I mean, that's so much value. That's so invaluable for any startup business at this stage. Yeah.
Fair enough. Samuel.
Excellent. I think that my fellow panelists have really touched on a lot of the points I would have mentioned. As someone that's worked with a construction company, I find that it can be very labor intensive. They tend to work with a lot of contractors. So things like, obviously we know things like Xero and QuickBooks and Sage have updated themselves to be very AI friendly. They automate and things like that. But there are a lot of plugins that you can work with tools like Zapier, for example. And what that means is that if you're working with quite a number of contractors, what they're predominantly looking for is things like that can help to automate with expenses, for example, or payment approvals. There's a list of them out there. I love working with tech. Harriet mentioned one of them being Dext as well, which is for expenses. You've got Teleroo, you've got Payhawk, for example. And to be honest, some of these things do and will automate your organization and make your organization run more efficiently. I've worked with a few construction companies. It will surprise you to know how a lot of them actually just work from pen and paper, simply books, writing down and people's names, and nothing about that is automated. And what happens is that something that should be taking less than an hour would actually take quite a number of hours to actually get done. So I understand this person's pain point. I've seen it all too well working with construction companies. And yeah, there are tools out there. You just have to do your research. Obviously, I think I would back up something that Manny said, is that first identify what your need is, right? Because if you're just looking for a product first, you're going to just end up buying everything. Find out what your needs are, understand your pain points, and then work from there. Thank you.
Thank you very much for that. Quick reminder to those of you on the live streams, we are unable to monitor your questions there live. So if you do want to ask our amazing panelists anything, you'd have to join us here on Microsoft Teams. It's audio only, and you can join from anywhere via any platform or device. And if I can ask my panelists to please mute yourselves if you're not talking, because it creates an echo, that would be great. So if for any reason the links on the live streams aren't working for you, you can always simply go to our website, startuptoscaleup.club, click and find today's session, which is Startup Finances Q&A 04. Click join. It's a quick registration that gets you a link to your email, and then through that link you can join us here on Microsoft Teams. It's audio only. Once you're here, simply drop your question in the chat. We'll give you the mic and you can ask our panelists. On the other hand, if your questions today are not on finances, please save them for the other conversations we host. Mondays it's talent, Tuesdays product and tech, Wednesdays growth, Thursdays fundraising, and then once a month on the second Friday of each month, UK Startup Law, and third Friday of each month, it's UK Startup Finances. And they're all from 12 to 1 p.m. UK time, and you can RSVP to any of those future sessions via our site, startuptoscaleup.club. This one, I've put it in the chat and we can start. I'll read it out loud though in a minute for the people that are listening to the live audience, sorry, to the live streams. But with this one, we can start with Harriet, then Sam, then Manny. So the issue here is aligning financial data with investor projections. We're an agri-tech startup providing soil health monitoring solutions for UK farmers. We're based in Newcastle, and the challenge we have is that our startup's financial data does not align with some of the investor expectations that we've dealt with, particularly around revenue growth and operational expenses. So basically, the situation we're in is that revenue generating bootstrapped with a growing network of farmer clients. My question is, as an agri-tech startup, how can we align our financial data with investor expectations whilst maintaining accuracy and compliance? What UK-specific practices, such as benchmarking revenue growth against industry standards or providing granular breakdowns of operational costs and highlighting VAT recoveries on pre-trading expenses, should we adopt to build investor confidence during due diligence? I don't know. I get a feeling he's asking how can we fiddle the numbers to showcase investors that we're doing well. Let's start with Harriet, then Samuel, then Manny, please.
So I think, in essence, what the question is getting at is saying we need to talk to investors. And I'm not sure if these are investors that you're prospecting with or if they are your existing investors, but you want to make sure that they're seeing the data in a way that is possible for them to judge, how that performance is looking versus standard metrics that they are looking at. And also, at the moment, you've got it set up maybe how you had it before or how it relates to you and how you do things. So I would say, the main thing is when you are, the due diligence is obviously more detailed, but when you're talking with investors, you've not got loads of time. They're not going to spend ages going through your models and your figures. So what you need to be able to do is have, one sheet within your models that has, lists of very concisely and very high level potentially the key benchmarks that and I would say look at the industry and maybe what's being reported about it to pick out what those metrics are. Failing that, I would use standard ones that that is recommended for startups to use. But I would have very clear detail on that so that they can look at that and get what they need to know. But as well as that, I would make sure that you are really transparent, so you've got the other levels of detail you can get into. So if they say, oh, that metric looks unusual, what's going on there, you can tell the story and you can explain it and you can go to another tab or somewhere else and very easily pull out the detail behind it. So I always say that I think it's a balance between, yes, show them what they need to see really concisely so they can, they're going between lots of different things, lots of different businesses. They don't want to be spending ages trying to find out key bits of information, but you definitely want to be transparent and be able to then flip to more detail and pull out what it all means. So when you're doing this, it's the presentation, but it's also being confident to talk about it as well as that. I would say that's the kind of confidence piece to build their confidence that as soon as they ask you a question, where to get the answer from. Or obviously, if there's no answer, then you talk about it. But if it's about your data, then you need to be able to drill down as well. So high level information that you can drill down into.
Enough. Thank you very much, Harriet. Samuel, what would you do
here? Fantastic, Harriet. That was very well said. I think the only thing I will add, similar to what Harriet said earlier on, I think that they have to create investor-ready financial models. ideally over 1 year, over 12 to 24 months. Their forecast revenue, they should show their forecast revenue growth realistically, which means it should be grounded in historical traction. Also, they should include the unit metrics. I'm guessing that whoever is actually investing is somebody that has knowledge of the industry, right? So have metrics and your economics in there, such as gross margins per acre, per farm, however it's done there, right? Because these metrics are very important to an investor when trying to invest in your business as well. Now, if you don't have, maybe you're a startup and you don't have all of that information, then you can benchmark it against the agri-tech standards within the UK, right? So it could be revenue multiples, it could be growth rates. And so things like this are easily accessible out there on the internet. It's just a case of actually doing your research. You mentioned something about VAT as well. You're right, Anton. I also misinterpret that as somebody doing something that they shouldn't be doing. But one thing I would say there as well, especially if you're a startup, and we're talking about agri-tech, which means that there's probably some innovation in there as well, is that they can reclaim VAT on pre-trading costs. So any VAT or anything they've purchased that they haven't claimed VAT for, they can actually claim it for the period they didn't actually start trading as per se, right? And also, you can include in there your R&D taxes as well, tax credits. We're talking about agri-tech again, so my assumption is that there could be or should be some innovation somewhere. These are the things that they can look out for with regards to your question about VAT recovery. Thank you.
Hello.
Yes, Manny.
Yeah, thanks very much. I think, with most startups that have raised money from investors, and there has to be kind of matrices you have in place to use to communicate with them on a regular basis. I don't think investors are naive enough to think that when they put money in your business, it will always go to plan. But what they don't want is surprises, in terms of, you keep something secret from them, or them not realizing the trajectory of the business at any point in time. So what I would suggest is, when you raise the money from some investors, you give them some estimates and your business plans and some matrices. I think it's important to now start having more regular communication. It depends on how the business is doing. If the business is tracking the plan you gave them while you raise money, then maybe keep the communication to them on a monthly basis and say, look, we're tracking plan, things are working fine, and give them what I would call a latest estimates of of a 12 months running focus initially. But if the business is not tracking plan as you would have expected for various reasons, which happens all the time, it's not the end of the world. Loads of business don't go to plan initially. The important thing is to find a way to communicate to them as early as possible and highlight red flag situations you're facing, but not just red flag the situations, but don't just tell them about problems, talk about solutions. What are we going to do now to correct this, to make sure that we structure the business back to a plan that we think will work better? I think this is very key, because if you don't communicate that to the investors, they'll lose confidence. And what you're trying to do is, you don't want the investors to lose confidence. So when you highlight and red flag a problem, we've not had this much, say, customers, for instance, that's because blah, blah, blah. But what we are now doing to make sure we rectify that is this. So I think, communication is important. You don't need to make it too complex in terms of just, your profit and loss, and choose some key matrices of the business, which include your cash generation, customer retention, and your growth trajectory, and your cash burn rate as well. I think that would be enough for investors to get comfort. because when you need to, if you ever need to go back to them for additional cash, you know, you don't want to go to them when they're very surprised that the business has not done very well for the last 6 months. So you don't want to put yourself in a position, you want to have investor confidence at any point in time. So keen, clear, honest communication is important, and making sure they have confidence in the startup team is critical. But if they feel misled or they feel there's no trust, you will quickly lose the confidence of investors. So, you know, keep it simple, give them, you know, focus, tell them what you have achieved, and be very honest. But if you are tracking your plan, you know, maybe keep it to monthly. But if you are not, maybe red flag it every week for them to understand how you're doing. And in most cases, some of the investors you have might have a lot of experience in running and driving business, and then maybe be able to actually give you suggestions in terms of strategy. That's my piece of advice. Thank you.
Well, thank you very much to all three of you. I think Samuel and Harriet, I think you were with us last month, weren't you? I feel like this question I've just put in, I don't know why, but it feels familiar. So I hope we haven't gone through it last month. Addressing payroll for multiple founders in bootstrap startups, travel tech. Do you think that might have been sent to us last month, or you can't remember it either?
I think we didn't have time for it. That's what I recall. I think it came in towards the end, and you said, "Oh yeah, let's park it till next time." Yeah.
I see. Okay, super. All right. Well, let's go through that quickly. If we can, all try and keep our answers to about a minute this time, please. So this is about addressing payroll for multiple founders in bootstrap startups. It's a travel tech startup offering bespoke itineraries for small groups. They're based in Liverpool. The challenge is that with multiple founders, the company faces challenges in balancing equitable pay with cash flow constraints during its early stage growth phase. So, revenue generating bootstrap with seasonal revenue model. And the question they have is, as a travel tech startup with multiple founders and limited cash flow, how can we structure equitable payroll arrangements to support fairness whilst preserving liquidity? What UK specific practices, such as differentiated pay based on roles or deferred compensation agreements or HMRC approved director loans, should we implement to ensure transparency and alignment with cash flow realities? So we can start this with Sam, then Manny, and then Harriet, and let's keep it to a minute each, please. Samuel?
Okay. I don't think I was very clear with the question, but okay, go ahead, Sam. Okay.
Excellent. I'll just try to address this very quickly within a minute. I think the first thing they need to do is define roles and value contributions to determine the salary intake. I think there's a misconception, just because there's 4 founders doesn't mean they're all contributing the same. I'm currently working with a startup at the moment. They're an underwear startup, and there are 3 founders in that startup, for example. One of them is still a part-time worker, but the other 2 are fully delved into the business, right? They've gone all out, they've quit their job and gone all that. So their pay won't be the equivalent of somebody that's not actively engaged. Remember, we're not talking about shares in a company, we're talking about salary here. So it should reflect your contribution there as well. And I remember in our last meeting as well, we briefly spoke about the kind of salary we can take, and it's the lowest form of salary, you know, the 12,500 that you can take out in terms of salary, where you don't pay any income tax, but you will pay some NI contribution. You can take out less than that if you want to. And then we were also mentioning in our last meeting how to investors, somebody taking out dividends is not something that is advised. So usually where we have the split between, usually get advised about the split between salary and dividends. As a startup and maybe wanting someone to eventually invest in your company, taking out dividends is something that's usually frowned upon. So the lowest salary lowest salary is £12,500, and yeah, that's my 1 minute up, I think.
Thank you very much, Samuel. Manny. No,
Yeah.
Manny, sorry, go on.
Okay, I wasn't quite clear about the question. If you just, repeat it again quickly for me, I really appreciate it. Apologies.
No, that's okay. The question is in the chat. You can read it as well, but that's fine. I'll read it out loud.
Yeah.
So the problem they have, or the challenge, is addressing payroll for multiple founders in bootstrapped startup. They're a travel tech startup offering bespoke itineraries for small groups based in Liverpool. They've got multiple founders, 4 to be precise, I think. The company faces challenges in balancing equitable pay with cash flow constraints during its early stage growth phase. So basically, the way they're at the moment is they're generating revenue, they're bootstrapped, but they've got a seasonal revenue model. So the question is, as a travel tech startup with multiple founders and limited cash flow, how can we structure equitable payroll arrangements to support fairness whilst preserving liquidity? What UK-specific practices, such as differentiated pay based on roles, deferred compensation agreements, HMRC-approved director loans, should we implement to ensure transparency and alignment with cash flow realities?
All right. Thanks for that. I think fundamentally the partners should come to an agreement, in terms of sweat equity and what is affordable by the business. I think, with most startups I've worked with, when I've had similar challenges, like, okay, what can we afford? So if it's £200 a month or whatever it is, then the rest could be, part of your sweat equity. I think there are loads of models out there whereby they could look to say, okay, for the cash you're not getting now will be added to your sweat equity of the business. That in itself will help create fairness among the founders, because you have some that are probably doing more than the other. And the ones that are not collecting adequate cash, should not feel as if they're losing out. They're getting some element of sweat equity. I think that I think is that's important for them to actually explore. I don't think they need the huge amount of UK regulations to be able to help them make that type of decision. That's my 1 minute.
Thank you very much, Fanny. Last but not least, Harriet.
So there's some really great points, and I think what I want to say kind of builds on that. And I would say, maybe controversially, don't focus on specifically what people are doing, because in any startup you don't get paid for what we've all been there. You don't always get paid for everything you do. There's an element of, I'm doing this because in the future it's going to extrapolate into whatever. So I would say definitely sit down together and have a really open discussion about the needs. So what's everyone's expectations? So, there's 4 of you, it's quite complex. There's risk if you get this wrong, you could fall out at some point. So this is really important to have this conversation. Make sure you're aligned. Does anyone need money to fund, have you got other jobs as well? Or are you all in on this? Work out what you actually need from this. Do people have, I need this to pay the bills, it's really important to me that I have this money. And other people might say, actually, I've got another job, it's fine, I'm just here skinning the game and seeing how this pans out. So I would definitely then document that, maybe in some sort of memorandum of understanding or something like that you can refer back to. This is our logic at this point in time, and it might change. And this, because there might be different things going on where you say, well, actually, we need to give you £1,000 so you can actually get involved with this, but I'm okay because I've got this other thing, I don't need to draw anything at the moment. But you want to document your thought process and what feels fair, thrash that out, talk about it. Does it feel fair or not? Is anyone feeling resentful? But being, you can't always get paid for exactly what you've done. And if you spend too much time totting up who's done what, you probably won't get on and be able to sustain a business for the future. But it will depend on, you said that you've got, I think, tight cash flows and things. So, this will ease over time, and there'll be, that to think about as well. But that's my initial thought.
Thank you very much, Harriet. We are now 1 minute over the line, so we need to wrap this up. Harriet, since you spoke last, would you like to go first with the some parting words for us, and then maybe we can go to Samuel and then Manny, please.
Sure. I think yeah, really interesting questions, and I think there's there's some definitely different dynamics when you've got multiple founders. I think that's certainly been the last question we've looked at, and yeah, that kind of extra complexity. So I think definitely don't underestimate that it's tricky when you're dealing with multiple people with different expectations.
Indeed, thank you very much, Samuel.
Fantastic. Wanted to say thanks for the opportunity. Appreciate my panelists as well. Very insightful conversation. I think the one thing I'll leave with here to anyone listening is trying to grow a business is like, I've heard it said so many times, is like driving a car without a speedometer, right? Or without a gauge, right? Get your numbers right and see how your business scales. All of the questions here today seem to be linked towards that. Believe you me, if you get on top of your numbers, scaling becomes that much easier. Once again, I want to thank you for your time. I've put my details in the link. If anybody wants to ask me any questions, feel free to ask me any questions on LinkedIn. Once again, thanks for your time today. Speak to you soon. Bye.
Thank you very much, Samuel. And last but not least, Manny.
Oh, Anton, this is fantastic. It's my first time, and I've thoroughly enjoyed it. I think it's such a great idea to get us together. I've really enjoyed the conversation, and the panelists have, pointed out very, very good solutions and advice for startups. For the startups, I think if you enjoy the journey, please don't leave it too late to seek advice from experts and professionals like us. I think that's really important. I think you might think it's expensive, but it's not as expensive as making a bigger mistake, and not getting the advice you need when it's too late. The reason we have fractional CFO is because we charge a fraction of the cost. So don't leave it too late. We charge hourly. So we might be able to even support you without a lot of money. So please don't leave the advice and reach out to us as soon as you need any particular support. We might be able to save you a lot of hassle in the future. Thank you very much.
Thank you very much, Fanny. Huge thanks to everyone that tuned in today. Obviously, very grateful to my panelists. Whilst we appreciate you sending questions, it would be nice if you can be bothered to be here live, because one, it makes for much more interesting conversations, and most importantly, it actually helps our panelists give you better answers if you are in the chat here with us. So please remember to do that next time. Just a reminder, we run 6 regular events: Mondays Talent, Tuesdays Product and Tech, Wednesdays Growth, Thursdays Fundraising. Then once a month we do a UK Startup Law, second Friday of each month, and third Friday of each month normally we run the UK Startup Finances Q&A. Next month, because of London Tech Week, and we're doing this as part of sort of the fringe events for London Tech Week, we'll be running both legal and finances on the same day, Friday. I believe it's Friday the 13th, if I'm not mistaken. As far as my parting words are concerned, just remember the startup journey can be both exciting but also quite challenging. So try to have some fun in the meantime, and be kind to yourself and everyone else for that matter. Oh yeah, one more thing. Next week, because it's half term and most people will be away, there are no sessions. So our next session is live on the 2nd of June, I believe, if I'm not mistaken, and that will be on talent. So by the way, you can RSVP to any of our future sessions via our site, startuptoscaleup.club. And actually, when you're there, you might also want to join our WhatsApp community. We've got some amazing groups of founders investors and operators that we can join that. Thanks again, and God bless you all. Bye-bye for now.